Hello everyone, welcome to Property Finance with Lee. Today we're diving into a challenge that many of you property investors may have thought about. And that is, how do you purchase an investment property when you've exhausted your borrowing capacity or can't produce good financials but have a deposit ready to go? Stay tuned, I have the answer. So many of us have ran into this problem, yet few of us know there's a solution. The biggest issue facing property investors is that we end up exhausting our borrowing capacity. Due to borrowing capacity calculations, it is difficult to keep hopping on to more and more property purchases. But this also affects people who no longer make a primary income. Perhaps you're retired and living off dividend yields, or have a foreign income source and have a bunch of savings in the bank with nothing to spend it on. Whatever the reasons, producing financials capable of getting you further lending for an investment has proven difficult. So what have your options traditionally been? For most, it's sitting on the sidelines waiting for the situation to change. I guarantee you that most mortgage brokers out there are giving this exact advice to people. But what if I told you there was a solution to this problem? A lease doc loan. A lease doc loan is an alternative to traditional means of financing a property investment. Why? Essentially, a lease doc loan application is judged solely on the income produced by the lease on the property. There is a catch. It must be a commercial property with a commercial lease. How does this work in practice? To illustrate this, let's imagine there's a warehouse which has caught our eye. The asking price is $2 million and is returning a net amount of $140K, or 7%. Now our plan is to get financing through a lease doc product, which most lenders will lend out at around 70 to 75% LVR. So we know we're going to need a deposit of at least $500K plus stamp duty to be able to purchase and finance this property. Is that it? Not quite. The net income needs to cover interest by a certain multiple. Every lender is a little different, but a good rule of thumb is that the net income generated by the property should be 1.5 times the amount of interest paid. So, if we're looking at an interest rate of say 7% or 105K in interest against our $1.5 million loan, our lease income needs to be 157K to cover the interest amount. In this example, our income does not cover our interest rate by 1.5 times. So although the banks offer a max LVR of 75%, the income does not qualify us for a loan of this size. So let's work out how much interest our income can cover. Using some math, we can find out it can cover interest of 93K, which at 7% represents about 1.34 million in lending. We now know, provided we have 660K in cash, plus our stamp duty, plus the application fee of the lease doc loan, which is generally around 1.25% of the loan amount, we can finance this property at 67% LVR without needing to provide personal financials. Amazing, right? The property's financing is judged simply on its own merits. What I love about this product is that you can scale your property portfolio without worrying about maxing out your borrowing capacity or producing financials. Lease doc loans can simplify the path to your next property investment. If you have specific questions or want to explore this option further, contact me from the details below to request a free loan strategy session. If you got value out of this, drop a like for the video, and if you want more content like this, subscribe, and I'll catch you guys in the next one. Thanks guys.